How do you determine that this is the right property or right client to work with? That's the number one question on the due diligence. And then you also mentioned the underwriting. So what exactly you're underwriting? Exactly the same like your client is underwriting, or you underwrite a little bit differently than the client? Because that's important for you to understand the numbers. Like if the client is making money, it's going to be paying you back. So it's kind of correlated, the whole thing, and the due diligence.
Yep. So we definitely want to keep a forward eye on what's going on with the borrower. So for example, if the borrower plans on refinancing this property, we want to make sure that they stand a pretty good chance at actually qualifying for that refinance loan. So we're going to talk to them about their cash flow. Do they have assets? During the peak of the pandemic, some lenders wanted to see 12 months of PITI in the bank before they would do a cash out refinance for you.
This is the Real Estate Vibe Show, and I'm your host, Vinki Loomba. And today I have a very good friend of mine here with me, and her name is Alex Breshears. Welcome to the Real Estate Vibe Show, Alex.
Thank you so much for having me, Vinki.
Yeah, I've been waiting for you for a long time to come to my show, and let's talk about private lending. So a little bit about Alex. She's a private money lender, short-term rental owner, and published author. She believes in the power of passive income through real estate. She's dedicated to educating and empowering investors through her book, Lend to Live, and Facebook group, all while championing financial independence, especially for women. Alex is a military spouse, mom of 4 dogs, horse owner, and seeks to educate others about investing. She was a chemistry professor, which I didn't know. That's good to know today. Teaching for a 4-year school for past 10 years with a special focus on pharmacology. So welcome again, Alex. I'm super excited to have you with me today. Our topic of discussion today is private lending, your path to passive investing for an active life. So before we get started, I wanted to ask you a quick question. If you can explain what private lending is and how is it different from the traditional modes of investing, like, for example, real estate syndication or any real estate investing or stocks and bonds or whatever you're doing. So if you can shed some light on that.
I'm so glad you asked. So in a really quick phrase, really private lending is you are the bank. So traditionally when an investor wants to buy a single family home, 3-2 ranch on the corner of your street, they are going to go to some sort of lending institution to get the money to buy that property. So in private lending, instead of going down the street to the bank or going to a large nationwide lender, they're going to come to private individuals like myself and say, hey, I want to buy this investment property. I need the money, in whatever the terms are, to buy this property. There's going to be a secured legal instrument, usually a deed of trust or a mortgage. There's a promissory note, some state specific disclosure stuff. But basically your interest, the money you've put forward, is backed by the asset, which is the real estate. And then that backing is made known through public records. So someone can go and search the deed of trust or go and search the mortgage for that property and shows up that you have what's called a lien on the property. So it's very much a kind of, it's private, it's an agreement between two people, their business entities, whatever it is, that I will lend you this amount of money for this specific purpose for this amount of time under these interest rates, these origination points, and say, okay, sure, everybody agrees. And then legal paperwork moves forward and the transaction closes. So in all reality, all private lending is you are acting as the bank.
How did you start? How did you become your own bank?
So by accident, by many things like in my life. So my spouse is active duty, like you mentioned, and over the years we have moved 21 times. And you just kind of, if you think about a Venn diagram of people in the military, people involved in real estate, there's this sliver in between where there's people in the military and people in real estate. And just kind of as we moved, we kept kind of bumping into the same people. And we had tried active investing. We had been landlords, we had done a fix and flip. we vehemently hated both of those things and refused to ever do them again because it didn't fit with our lifestyle. And we unfortunately didn't realize that until we were already eyeballs deep in both of those projects. But as we kind of, met other people, met other active duty service members, maybe they were staying in the area longer than we were. And we just made friends with them and they said, oh, I'm looking, you have an interest in real estate. I have an interest in real estate. We get talking. And then they would say, oh, I want to buy 123 Main Street down the street from my house and turn it into a rental, but I don't know how to do that. And then we kick around, brainstorm ideas. And it finally, just like the first loan happened, active duty service member came to me and said, hey, I really want to buy this house, but I don't have all the money needed for the rehab. I can do the down payment. I can do part of the rehab, but I don't have all the money I need for the rehab. And I was like, okay, cool. Like, I can do that. He's like, really? I was like, yeah, like what could go wrong, right? So you just start, when you're in the beginning stages, you don't know what you don't know, right?
Right,
So
exactly.
fortunately, I was at least, I knew enough where I at least knew I had to get an attorney involved. They actually drew up the documents. They handled the closing and everything. So it was relatively hands off for that first loan. But as you kind of learn more, and I worked in the lending industry before this, so I was at least familiar with the terminology, the process in general terms. But the nice thing about private lending is you don't have to go it alone, right? Like you have a title company that's involved making sure you have clear title. You have insurance agents that are going to make sure that you have adequate coverage as the lender for that property. The borrower has to buy that coverage. The borrower has to buy lender's title policy, right? There's an attorney. You can have your own attorney involved in the closing that draws up the documents and everything. So there's this whole, and I talk about it in the book, there's this whole parade of people that can be involved in a transaction to kind of almost double check your work, so to speak. And they're actually there to help protect you as the lender. Like I mentioned, lender's title insurance, the hazard insurance, you can hire a real estate attorney to help review the documents for underwriting, draw up your documents before closing. So it's not something you have to go alone, which I really like.
Interesting. So you started by default, but you have the background in lending before, right? You understand the terminology and everything. So if somebody's looking to start as a private lender, or the terminology that you use, become your own bank, what it entails, how exactly somebody can do that?
So there's a couple different ways someone could be involved in private lending. And I kind of use it as a spectrum from least active to most active. So least active would be investing in something like a debt fund, which would be similar to the syndication deals, that you'll see for like multifamily, only instead of that money going towards the equity and the down payment of the property, it actually goes towards the debt for a property. So that would be the least active. You read the PPM, you agree with the operator's model, you're okay with the returns, you sign on the dotted line, you send over your money. The second one is what I would call brokering. So you find someone that, again, like and trust and want to work with. They can originate the deals. Maybe they do some of the underwriting for the deals, and then they go and present it to you and say, look, I found this borrower, I found this deal. Here's the loan to value. Here's all the metrics that we need. Is this something you're interested in funding? You sign yes or no, you're interested in funding. And then basically a lot of times your responsibility at that point is reviewing the documents, asking questions, and then wiring the money to closing. So you can use a broker to kind of help find deals that you're comfortable in having funded, hold your hand through the process. And then the most active version would be where you are going out there, you are finding the borrowers, you are doing all the underwriting, you are doing the documentation, you're finding the attorney to do the closing docs, et cetera. So it really depends on what someone's willingness for time commitment would be. So it could be all as easy as I want to sign up for a debt fund, all the way to like, I want to be the person locating the deals, underwriting the deals, and doing everything in between. So there's a spectrum of activity. It just depends on where you want to fall in that spectrum of activity.
Interesting. So when you first started, you said that somebody came to you and they're looking for some funds to close a deal. So what kind of clients do you get? Is this the people who cannot get a loan from the bank or the insurance companies or wherever other they come to the private lenders? And the second question is a two-part question. So when we're looking to start, why did you opt in for the private lending versus going as a JV with somebody? What is the difference between the two?
So for the JV one, that's pretty easy. Like I mentioned, we had been a landlord. We had been someone who'd done a fix and flip. and it didn't fit in our lifestyle. And it also, more importantly, didn't fit in our skill set. Like, please don't make me pick out tile. I don't care what cabinets look like. I don't want to pick out countertops. Like, that is my own personal level of like hell. I just don't enjoy doing that. I also don't enjoy talking to tenants and doing move-in inspections and all of that. And so that part didn't interest me. And what most people don't realize, even if you're JVing, even if you're, quote, the silent partner, you're still on the hook for stuff like the mortgage payment. You're still on the hook for property taxes. You're still on the hook if damage is actually done to the property. You can't just go, hey, I put in my 30 grand, I'm out. Like, it doesn't work that way. You are a part owner of this property. So while everybody in the JV world talks about, oh, great, it's equity, you're building appreciation, that's great, they don't often talk about the downside. And there could substantially be a downside if the property's not managed well. If, we just had a major hurricane go through. If the hurricane significantly damages the property, the tenant has to move out, and then you have $100,000 worth of repairs to do. That's lost revenue for those 4, 5, 6, 8 months the property's down. You as an owner, you take that hit on the chin. But as a lender, if the property is there, you have a loan on it, their mortgage payment is still due. So for me, my lifestyle and my strengths, I'm much better being collaborative and going, here's the capital. I know what it's going towards. I would just like my cash flow, please, because I have other things that I want to focus my mental bandwidth on. I don't want to pick out tile. So it's not to say I'm against JV, because I have JV, partnerships with people, but it's under the understanding that I'm walking into this knowing I could potentially be on the hook for more capital. I'm potentially on the hook for debt for this property. There's downsides that I'm very aware of, because I'm not constantly looking at like, oh, it's going to cash flow this much and it could appreciate, it's going to do this and it's going to bump my net worth. Like, that's great, but you still have to pay attention to the downside, and you still have to have some mental active energy towards that property. Whereas the lending model is very set it and forget it. I don't know if you remember those commercials with the rotisserie cooker thing. Yeah. It's very set it and forget it. The work tends to be very upfront. You're finding the borrower, you're doing your due diligence, you're doing the underwriting, you're getting the documents all ready for closing. You have the closing, and then it's just like, cool, send it off to the loan servicing company. The loan servicing company does the correspondence with the borrower. They collect the payments, they send them to you. So it's a very set it and forget it model. And that fits in my lifestyle, because I can sit down for a week and, talk to a borrower, underwrite an application, send the money over to closing, have a closing, and then it gets sent off to the loan servicing company. And then I'm like, okay, cool, what's next? Then I'm mentally free to go work on the next deal.
Wow, interesting. So how big size of this debt or the loan that you're lending into people in the lending space? Is there a limit to it? The minimum and the maximum, or is it like
the minimum? I would say that really depends on your risk tolerance. So for example, when I mentioned my first example, I was actually in the second lien position. That might not be something that some people are comfortable with. So the first loan I ever did was like $35,000 years ago, and I was in the second lien position. Now, given our current economic climate, I don't lend in the second lien position. I have done it in the past, in the very near past. But I only do first liens right now because of where we are economically and interest rates. That's a whole other podcast about the economics we are currently facing. So I would say minimum would be, depending on the area you want to lend, what you would think if you want to do first lien, what an investor could potentially buy a property for, and then roughly, maybe, 80-90% of whatever that purchase price would be. So I'd say realistically, if you want to be in a first lien position, even in a relatively cheap market, about $100,000 on up. It just depends on how much capital you have to deploy, what percentage of that you want tied up in one particular deal. I would say realistically, usually about 500,000 is about average for the upper limit for a first lien. So if you have active investors listening to this and they're like, oh, I'm going to go buy a motel with entirely private funds and the purchase price is 3.4 million, chances are you're not going to find a private individual that's going to have 3.4 million that they want to put into one particular deal and not have any sort of equity ownership. So if it's a property that has, it meets building codes. It doesn't need significant renovation. You have some time to do a closing. You got 60 days, 90 days on the contract. You can go get bank financing for the property. It's probably going to be a cheaper rate. It's probably going to be a little bit more favorable terms, but private lending comes into the mix in situations where potentially the borrower, not that they can't qualify, but it's more hoops to jump through, right? Like they don't want to have their credit pulled, every 7 days, because maybe they're taking down 3 or 4 properties a month, right?
Mhm.
Like they don't want their credit pulled 3, 4 times every single month, every time they go get a loan, because maybe they're pulling down 3 or 4 of these single family homes in a month. And then every couple of months, they refinance them into one portfolio loan with the bank. That's just one credit pull. So there's a myriad of reasons. They need a fast closing. A lot of banks, especially lenders, any lenders right now, they're not quick on closing. Like 45 days is probably about average. 60 days is probably optimal for a lot of banks right now. So if they need a quick closing, they want to do something that's like a cash offer to make their offer a little more competitive. They don't want to have any sort of contingencies for inspections. So if the bank sends out an appraiser and the appraiser says, oh, there's this structural problem and there's that structural problem, the bank could say, no, we're not going to lend on this because it has these structural problems, or it's not livable, or whatever the conditions might be. So it's not necessarily that the borrower can't qualify. A lot of times it's the property isn't going to qualify for conventional financing because it needs significant renovation. It needs updating. Maybe they're doing something like they're adding square footage to the property. And a lot of banks don't want to get involved in, construction loan type things. So that's a very specific product in lending. So I would say private lending fits in this nice space where it's either the borrower's running into something that they don't want to or can't deal with a regular bank or even maybe a hard money lender, or it's the property that's dictating that choice.
Yeah, but that's what you're doing, the upfront work, when you're doing your due diligence and trying to figure out whether it's going to be worthwhile to put your money there or no. So let me ask you this question. So when you're going through this due diligence process, how do you determine that this is the right property or right client to work with? That's the number one question on the due diligence. And then you also mentioned the underwriting. So what exactly you're underwriting? Exactly the same like your client is underwriting, or you underwrite a little bit differently than the client? Because that's important for you to understand the numbers. Like if the client is making money, it's going to be paying you back. So it's kind of correlated, the whole thing and the due diligence.
Yep. So we definitely want to keep a forward eye on what's going on with the borrower. So for example, if the borrower plans on refinancing this property, we want to make sure that they stand a pretty good chance at actually qualifying for that refinance loan. So we're going to talk to them about their cash flow. Do they have assets? During the peak of the pandemic, some lenders wanted to see 12 months of PITI in the bank before they would do a cash out refinance for you. So kind of being aware of what those downstream decisions are going to look like for your borrower are of prime concern. And so those tend to be the amount of liquid assets they have available, because banks are going to want to see some reserves somewhere. They're going to want to see income of some variety, whether that's going to be something like a DSCR loan, that's going to be, the income's going to be dictated from the property, or whether it's going to be in their own personal name and they have maybe W-2 income and then some income coming in from rental property. And then also potentially what the property is going to be valued at, because what a borrower thinks the property is going to be valued at and sometimes what the lender thinks it's going to be valued at are a little bit different. So we try to be conservative, because when you mentioned about the risk for private lending, there's going to be risk in any investment, right? It's not guaranteed. But what we try to do specifically, and what I try to do in private lending, is your risk is kind of situated at the beginning of the loan, because you are the one that's dictating what loan to value are you willing to go up to. You are dictating what you think the appraised value of this property is going to be. You are the one as the lender dictating the insurance coverage that you want, lender's title policy, the upper limits and coverage you want for the hazard insurance. Does it require flood insurance? Is it in a flood zone? So a lot of those metrics that you would consider risk as far as the property goes, you can dictate as a lender and you can control. You can say, I'm only going to go up to 50% loan to value. That's my max. I'm going to do 50% loan to value. So if this deal goes south, the worst you are into this property is 50% of what you think it's going to appraise for. So there's lots of ways to control your perceived risk in a loan. The one thing we can't control, obviously, is the people. So there's nothing that's going to stop that borrower from potentially stepping off a curb and getting hit by a bus 5 days after they close. And then obviously the project's not going to move forward. So that's why falling back and having those kind of risks assessments saying, oh, well, here's what we have, here's what we have. I'm only into this property at 50% loan to value. So even if they've done nothing to it, as it currently sits, I'm at least above water, right? Like there's at least enough equity where if we have to foreclose, if it goes to a foreclosure auction, it should sell for more than what I am owed as a lender. If it doesn't sell and I have to take, title back to this property as an REO, do I have the bandwidth, boots on the ground, time, commitment to finish rehabbing, renovating, whatever the business plan was for this property, and then turn around and sell it? Or do I have another investor in my network that say, I can go to Joe and say, hey, Joe, I just took this property back REO. I don't want to rehab it. Is this something you're willing to buy? I'll do the financing for you if you're willing to buy it at this price. So everybody kind of perceives this foreclosure is this, I call it the nuclear option, right? Like everybody's like, oh, it's this big, huge, terrible thing. But if you did the stuff in the beginning correctly and you check the boxes for what you perceive the risk to be at that time, chances are you're going to come out ahead. You're going to at least break even, but you're probably going to come out ahead. Where people get in trouble with private lending is where they come in, the colloquial term is gator lending. They'll kind of come in behind a hard money lender. They'll come in as a second lien, but they're all the way up there at 100% combined loan to value. They have an investor that's buying it for 100%. Maybe they're going to turn it into a short-term rental and they buy it for 100% of the purchase price. It's listed on MLS. And then they come in with their second lien and say, oh, I'll provide the 20% down payment for this. Well, you're at 100% loan to value at that point, and you're behind another lender. If the market even dips a little bit, your loan is now underwater. If they foreclose, if the first lender falls behind, that default interest, the legal fees, everything else is going to wipe you out. So it's really a matter of, do you have enough equity in the deal to make yourself comfortable? And I think a lot of people, they think of private lending as the person that's putting down that 20%, and that's not what we do. There's people out there that do that, but that is not what we do.
Interesting. So I assume these loans are recourse loans, all of these, because you mentioned REO at some stage, like if, let's say, if the owner hit by the car, I'm going to use the same analogy, or if there's a foreclosure. So what happens at this point? The property comes back to you. How do you recover your money?
So that's going to vary again, depending on private lender, but it also is going to vary on the paperwork, which is why I'm very adamant about getting professionals involved. I'm not a lawyer. This is not legal advice, but I'm going to go to a lawyer who can give me legal advice. And so, for example, in our documentation, we have a personal guarantee added to the note. So we have an initial addendum to the note that says personal guarantee. So personal guarantee kicks in if the property forecloses and we cannot be made whole. And the company, the LLC, because our borrowers are going to be businesses. So if the LLC, for example, then also can't make us whole, then we have the ability with a personal guarantee to go after the personal assets of the borrowers. So personal guarantee kind of falls in like third in line. It's the property, the company, the business entity that was the original borrower, and then it's personal guarantee. So again, like I mentioned earlier, at the very beginning stages, making sure you have all those boxes checked really sets you up gives you more options later on to be made whole or to, collect what is owed to you as the lender.
I like that, because being a lender, you're just kind of writing your own story for each property, how you want it to perform or which way it's going to go. Because if you're going to do blindly, it might not work for you, because you are kind of on the driver's seat, the way I see it. And I'm going to ask you one question here is, you're talking about the attorneys and then you mentioned the loan servicing companies, and you're using insurance companies, bunch of different vendors that you're working with to make sure the deal goes smoothly. So there's cost involved to get all these pieces together for you as well. So what is the cost for you? And does that kind of interfere in the interest rate, right? How you set the interest rate, what are you going to charge on a particular loan? That drives that, or how does that work, the whole calculation there?
So here's the other benefit of private lending is somebody else pays for you to be protected in your investment. So the borrower is paying for the hazard insurance. The
Mhm.
borrower is paying for a lender's title policy. The borrower ultimately ends up paying for the document. We call it a doc prep fee. And a lot of lenders will charge like an underwriting fee, a processing fee, a doc prep fee. They might name it different things, but ultimately that's going to offset the cost of having the documents professionally drawn up by an attorney. So the costs, like true costs as a lender, are relatively low. If anything, it's just wiring the money to closing.
Okay.
So, or a property valuation, if you're someone that wants like a full appraisal done, yeah, you can ultimately charge it to the borrower, or maybe have the borrower pay the appraiser directly. We pull desktop appraisal. We have a service that does that, and that's a nominal cost to us as a lender. But again, as soon as it closes, we are paid back from our underwriting fee. So if you're looking at it from a lender's perspective, the costs are very minimal. The loan servicing company is a monthly fee. Usually they're anywhere between $15 and maybe $40 a month, depending on the company and the amount of intervention you're paying for them to do. So it's relatively minor as far as costs go. And a lot of the costs are covered by the borrower just in the normal course of a real estate transaction. It's generally not anything kind of above and beyond.
So how do you set the interest rate? It's like the market interest rate, or how do you go about that? Like how much you wanted to charge? Because you're your own bank, you set your own standards, you're setting up your own policies, how this deal is gonna go from conception to completion. So what is your take on that?
So my personal take on interest rates is that is not the most important number in the transaction. And I know a lot of investors, active investors, will really drill into that and like, what's your rates and terms? What's your rates and terms? Like, well, hold on, pump the brakes. Like, there's a lot of other factors that are far more important to your deal than figuring out the rates and terms, because a lot of private lending is loans that are under 12 months. So if you want to quibble with me about paying 11% over 12%, and like, okay, you might have the loan 3-4 months. What is the actual numerical difference between paying 12% versus 11%? And what are you getting in return for that? Like, you're getting someone you can talk to, the decision maker, right? Like, you're actually talking to the person who's going to value the property, who's going to draw up the documents, who's going to negotiate the terms of the loan with you. If that's worth like $300-400 extra, then do that. But I see a lot of people really dive into the annual interest rate. So as an example, this is a story, I actually had this happen. I had a borrower really hold on to this 11% interest rate. They were not going to pay over 11% annualized interest. And I'm like, okay, cool. But like, for the terms of this loan, because it's a little bit higher at loan to value, you're not a very experienced borrower, we're going to have to require at least 12%, if you want to move forward. And he was adamant. He's like, I could go get 11% from another lender. Fantastic. Go do that. Please do what's best for you as an investor. And then we didn't hear from him for a couple of weeks. And then he showed up one day, he sent me a text message, and he's like, I really need to close this loan in 3 days. And I'm like, what? So it turned out he got the final settlement statement from the closing company with this other lender. The other lender wanted 12 months of prepaid interest collected at closing. He got his 11% number, but the lender required him to bring an extra like $14,000 to closing, because they were going to hold their 12 months of payments in escrow and then just kind of credit it to the borrower as the time ticked by. And he didn't know that little caveat to the loan, but he was so focused on his 11%. And they gave him what he wanted. They gave him 11%, but they also did 12 months of prepaid interest up front. And he didn't, because he was so focused on the 11%.
Yeah.
So because he wanted to, and I figured it out for him. I was like, because you wanted to save $766, you now have to bring $14,000 more to closing, because I can't do this loan in the next 3 days. I have too many other things going on. We have too many other loans going out the door. We just can't. I'm sorry. So he ended up closing his loan for 11%, but he ended up bringing a whole lot more capital to closing than he was anticipating, doing, because he didn't think about all the other terms that there are to a loan, other than what's the origination point and what's the annualized interest rate. And I'm like, dude, like, they gave you what you asked for. He was dogging on him. I was like, you walked in there and said, I want 11%, and they found a way to make 11% work. And that's how they made it work. So it's 3 days before closing. I'm sorry, you're closing with that loan.
Yeah, you need to have a holistic picture. It's just like, to me, it seems like, car salesman, they say, okay, how much you wanted to have your monthly payment?
Yeah.
And make it work for you, something like
right.
that.
That's exactly what it is. That's a great analogy. So like, when people come in, what's your rates and terms? I will tell them, like, obviously everything in real estate, it depends, right? It depends.
Right.
So for me, it's going to depend on the loan to value for the property. So obviously the lower loan to value, there's less perceived risk to my capital not being able to come back to me, because you're
Mhm.
always worried about return of capital, and then return on
On
capital is
capital.
secondary. So lower loan to value is going to be cheaper interest rate.
Right.
The experience of working with you as a borrower, if this is like your third, fourth, fifth, sixth loan we've done with you, you are not as much of a risk to us because we've had successful loans with you in the past. You've
Mhm.
communicated, you've rehabbed, your houses have hit the mark. So you have a positive experience with us. So you are not as much of a risk. So that interest rate is really a reflection of the perceived risk to the deal. So
Mhm.
for us, it's the higher the loan to value, how much money is the borrower putting into this property. So if we're funding just the purchase price and you're funding all the renovation,
Mhm.
cool, maybe we can do something a little bit better than 14% because it's a low loan to value. You're bringing all the renovation to the table. Cool, we can do that. So being able to talk to a private lender and have that conversation, that back and forth, and say, hey, here's how you can structure the deal. Like, we had a loan close a couple months ago. The borrower wanted to borrow money for the renovation. And she said, oh, well, we have 10% to put down into the property. And I'm like, okay, great. But that's about what your budget is for renovations. And so it's
Mhm.
going to be cheaper for you as a borrower if we don't have to hold back money and escrow money for renovation. So if we just lend on 100% of purchase price and you fund the renovation, that is less expensive for you, as far as we don't have to charge you like a management, escrow management fee or anything like that, a construction draw fee. And it's going to be a lower interest rate because we are less into the property as far as the purchase price. The loan to value is going to be 40, I think in her case, it ended up being 55%. And it needed just a small amount of rehab. So being able to have that conversation in real time over the phone and talk about numbers. And she came in and said, hey, I think the property is going to be worth about 120. I did some numbers and said, okay, yeah, I think that's good as long as you do these certain things as part of the renovation process, and then kind of dive back and forth with scenarios. She could go, oh yeah, okay, yeah, I could put about 10,000 into this deal. And okay, cool. Well, I can do this if you want to do that. And then it was a give and take and say, cool, let's do this. So being able to talk to the decision maker can be huge for an active investor, because you're going to have another set of eyes on the deal. And obviously we don't want to like make the numbers look fluffy, right? Like, we aren't going to go into the magic spreadsheet world and make this look like a home run, because it's not in our best interest to do it. So if an active investor comes to us and says, hey, I got this great deal, and then we get underwriting to it and be like, where are you getting those numbers? Like, what comps are you using? Like, we aren't seeing that number. Where are you seeing that number? Like, we're going to be honest and say, we don't see that number, and here's why. What are you seeing that maybe we are missing? You can have a back and forth. Whereas if anybody's ever got a bank loan, the appraiser goes out and whatever the appraiser puts on that piece of paper is gospel. There's no back and
That's true.
forth.
Hmm. Yeah, I agree on that. I think you have to know your own story first, before you bring the private lender or any lender into your story. So you need to understand that, you need to believe it. It has to be 100% accurate according to, your vision or best of your knowledge. And then let other people look at it like yourself, and then you're going to add much more value to it because you're going to be seeing it from a different angle, and which is important. I know you wrote a book, right? Lend to Live.
Yeah,
Yeah,
yeah.
congratulations, first of all. And you mentioned the CPR method in that book. So I just wanted to ask you a quick question about that. What exactly is it and how that's helping people? Because you're passionate about educating people and you already just gave us so many golden nuggets throughout this conversation. So share with me, what is the is it CPR method,
It's
right?
CPR, because it's
Yeah.
lend to live and then like CPR, like resuscitating somebody.
Right.
But basically, like you mentioned in the beginning, for someone that doesn't have a framework, they don't have a beginning point, they got to figure out how to put all these puzzle pieces together and make it a cohesive picture. The CPR method that I developed with my co-author, Beth Johnson, on the book was basically just a framework. It's a method to kind of systematically think through the loan process. So a lot of people might be very familiar with the kind of the loan terminology. There's loan origination, there's loan processing, there's loan underwriting, there's post-closing, et cetera, et cetera. We just made it a simple framework where it's very common colloquial terms. And then, so that would be all the C's. The P's are the different things that you need to pay attention to in that particular part of the loan process. And then the
Mhm.
R stands for risk. So obviously, like we've been talking about, there's risks with each level of the loan process.
That's
So
true.
here's the things to think about at this particular stage of the transaction is really the R. So
Mhm.
realistically, the CPR method is a framework to kind of put all those lending pieces and underwriting pieces and post-closing pieces all together to make a picture that is a little bit more digestible for people that maybe aren't super familiar with lending terms, or
Mhm.
just maybe not super familiar with the ins and outs of a real estate transaction. Because if you've bought your own home through like MLS through a realtor, a lot of work is done behind the scenes that you
That's
don't
true.
recognize as a
Mhm.
buyer because the
Mhm.
realtor's doing all this in the background. That's what they're getting paid for. So
Mhm.
when you as an investor are going and buying a property, maybe you buy a property off market and suddenly like you need to figure out what the mortgagee clause is. You didn't even know that was a thing when you bought your own house, right? So it's really just a framework to kind of simplify all of those kind of little nitty gritty details and put them into a bigger picture so you can understand the importance of all those steps and think about the pros and cons of each one of those.
Interesting. So we are out of time. We can keep on going, Alex. This is just an interesting topic. But I share one more golden nugget with my audience at this point, please.
One more golden nugget. I would say don't be afraid to ask for help. I think from the active investor community, there's so much of this like, I'm going to go buy a single family home and I'm going to turn it into a rental and I'm going to find the financing and I'm going to like maybe swing the hammer and do some of the renovation. It's a very different mindset when you get on what I call the other side of the table, where it's very collaborative. Like I mentioned, you have other people out there that have the knowledge base. Talk to your insurance agent, for example, say, hey, here's the coverage that the borrower wants to get. Would this be adequate in your opinion? Even if they charge you for a consult, $50 for a consult, just ask for the help. And people are more than willing, usually, especially in this community, to reach out and say, hey, like, I don't know about this, or I would do that. Did you ask them about this other thing? Ask for help because it's out there. It's available to you. There's people literally paid in this transaction to help you.
Yeah, I love that. Ask for help and collaborating. That's the best way to scale, anyways, because you can do only so much on your own. And I would say, no matter how much knowledge you have, still it's limited.
Yes.
Because when you're collaborating or using others' knowledge or leveraging other skill set, the growth is exponential. So this brings us to a rapid fire round. I'm going to ask you 5 questions. You're going to answer in 1 word or 1 sentence only, please. Are you ready?
I'm ready. Let's do this.
Okay, so the first question. What is one of the most important things that you have learned in your life and it always worked after learning?
I would say that everybody is damaged and hurt. Like it's really everybody you're dealing with is in some sort of emotional turmoil. Like if you've ever talked to a business partner and they just kind of snapped at you and you're like, what's your problem? Well, maybe they had a fight with their spouse earlier that day. So I think being able to humble yourself and have empathy for others and realize that everybody's hurting in some capacity, just showing empathy to another human being. I think that's it.
I love that. Showing empathy and not judging others. That's the best way to live. So share with me one of the best book that you read and recommend to my audience.
Oh, it's called Psycho Cybernetics by Dr. Maxwell Maltz. It's an oldie. I think it was written back in the 60s, has not been updated since. It's
Uh-huh.
a little dated, but it's a fantastic book. And it's a book about mindset, but it's kind of the grandfather to all the mindset books that are out there today. It was like the original. So I firmly believe, because people ask me, what's your favorite like real estate book or what's your favorite, this, that, or the other. I'm like, you have to have a solid foundation as a human being to make
Mhm.
those good decisions in real estate. And that solid foundation starts with knowing who you are. So I absolutely love that book for that.
I love that how you say you need to discover who you are, because that's the most important thing. Unless you discover who you are, none of the book's gonna make sense. Because once you figure out who you are when you're reading any book, your perception is gonna be totally different.
Mm-hmm.
And try that if you didn't try that before. I'm gonna add to it. Okay. The third question, in 1 word, what does life mean to you?
Family.
Love that. What is your biggest passion?
Probably horses.
Yeah,
I'm a,
I love the
I,
pictures with the horses. This is super
I am a
cute.
horse person through and through. It is in my DNA. I cannot escape it. So yeah, horses.
So you do the horse riding show? You're a
I
good horse
do.
rider.
I do.
Nice. I envy you. If you could turn back in time and talk to your younger self, what would that be and why?
I would have had a conversation very early on in my real estate journey about what are my goals and my strengths, because I burned through time and money trying the house flipping thing, trying to be a landlord thing, having lots of tears and mental breakdowns over those things. But I ended up that way because I went to a RIA meeting, and that's what everybody else was doing, right? So if you show up to a guru event about the BRRRR method, you're going to do the BRRRR method because you're going to hear about all the great ways the BRRRR method is awesome. But nobody has a conversation before you get in that room that says, does the BRRRR method actually fit your goals, your strengths, your lifestyle? And in my case, it didn't. And I just happened to kind of come across private lending, and it turned out it did. So I would say for anybody that's interested in getting involved in any kind of investing, not just real estate, really think about not only the money that you want to invest, but the time and what I call the mental bandwidth of whatever it's going to take to do that investing. I call it mental brain damage in my world. So if the return might be great, but if it's a super high mental brain damage, I'm sorry, life is too short. I do not want that mental brain damage. I will go do something else, even if it's a lower return, because it's not as high a mental brain damage number for me.
Exactly. I like that actually, because the other thing is when you're not occupied or your mind is not 100% taken away with one investment or two investments, you have some space to think about something else, right? More creative way of doing things and actually living the life. Like I say all the time, we should all learn to live, not just about chasing the material things or money or whatever, that's the most important thing that we have to do all. And thanks for on the show today, Alex. I really enjoyed our conversation. Could you please quickly share with me how can people reach out to you?
Sure. They can find me on Facebook. I run a educational group. It's called Private Lending Lessons. I'm on LinkedIn, so send a connection request over there, and happy to chat with you. If you happen to be on Facebook, send me a message. I love talking to people about real estate, about private lending, because I think just spending a few minutes with them could potentially save them thousands of dollars of mistake and maybe hundreds of hours of time of mental heartache. So I'd rather spend the time doing that. To me, that's worthwhile.
Yeah, thanks for sharing the Facebook group. I had a question in my mind and just some reason it slipped. I was going to ask you about your Facebook group, and you're doing really good and providing tons of education to people, which is amazing. So you wanted to add something to it about your Facebook group, a little bit more?
Yeah, so it's a community for active investors and private lenders for them to kind of come together, answer questions. We'll put up questions, hey, what's the origination points you're charging right now and why? Or, what are your hazard insurance requirements? So it's really kind of a collective. People can go and actually search the group for questions that they have. It'll pull up past posts, to get feedback. We do educational events, live educational events that are online. So it's really just a place for people to kind of come together and have a conversation about lending, whether you're a borrower or a lender.
Good. Thanks. I will add that into the show notes too. But thanks for being with me today, Alex. I really enjoyed it.
Yes, I did as well. Thank you for having me.